Welcome. In this presentation, my name is Nadia, NPM 234120026. We'll discuss how to calculate the cash ratio based on a company's financial statement. The cash ratio measures a company's ability to meet its short-term obligations using only its cash and cash equivalents. This ratio is important for understanding a company's liquidity, or how quickly it can cover its obligations without selling assets or relying on operating revenue. Investors and analysts use the cash ratio to evaluate a company's financial security. The higher the cash ratio, the greater the company's ability to settle its short-term liabilities without needing to sell assets or depend on revenue. The formula for calculating the cash ratio is as follows. Cash ratio is equal to cash and cash equivalents divided by current liabilities. The most liquid assets that can be immediately used to pay off debts, including cash balances, bank accounts, and short-term investments. Obligations that need to be paid within a year, such as accounts payable, accrued expenses, and tax payables. Based on PT Wasgita Beaton Precast TBK's financial statement for the year ending December 31, 2023, we have cash and cash equivalents of IDR 120,811,660,447. We also have current liabilities amounting to IDR 2,646,048 million, or IDR 2,646,048,000. Now we can substitute the data into the formula. Here's the cash ratio calculation. Cash ratio is equal to cash and cash equivalents divided by current liabilities. Equals 120,811,660,447 divided by 2,646,048,000 equals 45.6. Therefore, the company's cash ratio is approximately 45.6. This means the company has significantly more cash and cash equivalents than its short-term obligations. In other words, the company has more than enough cash to cover all its current liabilities. A cash ratio of 45.6 indicates that the company is in a very strong and secure financial position. Its liquidity is very high, so the company can easily meet its short-term obligations without needing additional funding. For investors or shareholders, such a high cash ratio is a positive signal as it reflects financial stability. However, it's also worth noting that an extremely high cash ratio may indicate that the company hasn't fully utilized its cash for investments or business growth. That concludes our explanation of the cash ratio calculation and how it helps assess a company's liquidity. We hope this explanation was helpful.